David, it's good to have you, particularly on a morning like this. Let me just start off with sort of the underwriting process from your perspective in terms of the decisions you guys are making every day. How has it changed, if at all, given the uncertainty you're seeing out there right now in corporate America?
Well, thanks for having me. I really appreciate being here. It is definitely an interesting day, an interesting morning. From an underwriting standpoint, our job actually is a little difficult today in terms of probability weighting outcomes. Obviously, the Fed is very committed to raising rates and squashing inflation. We're definitely seeing inside the boardroom of many of the companies that we sit in the boards or touch, difficulty in projecting what their budget's going to be for next year. So there is a high degree of uncertainty. And as a result, we are raising our, standards, if you will, around rates of return for a quantum of risk in the underwriting process today.
You are, yeah. Are you pulling back at all, just to a certain extent, or you're still committed to these markets, but as you say, only willing to do so at perhaps a higher rate of return?
I wouldn't say we're pulling back at all. We actually have $88 billion of dry powder. These are markets, frankly, and if you go back to 2008, 2009, even 2010, we grew through that market environment. And actually, these are markets and the volatility that we see in the markets that really fit our type of capital, which is extremely flexible in terms of what we do.
Do you see a default cycle coming? I'm just sort of curious, particularly given your long history and with so many of these predictions of recession. Or are we off in terms of, expecting sort of something that would be similar to what we've seen in the past?
Well, obviously, defaults right now are very muted. We don't see a wave of defaults coming in terms of a tidal wave. But certainly, when you look at 24 and 25 maturities, and definitely we're hearing in the market, owners of businesses with credit and borrowings that have 24, 25 maturities are starting to think about solutions today and certainly early in 2023 to deal with those. And whether the market contraction or market conditions lead to significant defaults, TBD. My crystal ball is as good as anybody's.
But I do wonder if you think that has something to do with the price action today, meaning if the conversation continues to pivot to how long the Fed, say, holds at a certain level, then maybe it's not so much about maturities in 23, but you do start to think about what comes up in 24 and 25.
What we've seen, Carl, in terms of, the companies that we touch, generally speaking, we're a little bit more senior in the capital structure. We're investing in and lending to more upper middle market companies that are a little bit more resilient. So that is, from a credit perspective and our positioning, we feel pretty good about that. But I don't really see a wave of defaults in the traditional sense. I do think you're going to see alternative credit and alternative capital being raised in 23 in anticipation of debt pay downs as well as maturities. So I don't really see the inability to pass along and protect margins yet.